Welcome to the third installment of a monthly series titled Asking for a Friend. This is where I plan to answer timely questions that we've received. I am your host, Eric Jefferson with Treasury Capital. And for today, I want to answer a question that came in last week, which, given all the recession talk, I wondered if now is the time to own government bonds. So in the pages ahead, I'll provide a quick overview of Treasury bonds and then outline the criteria we'd want to see in order for them to make their way into a portfolio. Before we go forward, do have a few quick words here just to keep the lawyers happy. As well, I want to reinforce this series is designed for all of you. So if you or a friend that you know has a question you'd like further clarification on, please don't hesitate to send it in. So to kick things off, I want to offer some context on government bonds. As you can see, they are debt securities issued by a government entity. That's one of the ways governments help fund their spending. You can see a government bond or debt security is in essence a loan that has a stated maturity as well stated amount of income or coupon that it will pay the lenders. Lastly, there you see because these are backed by the full faith of the U.S. government, they tend to be considered lower risk. Although keep in mind, lower risk does not necessarily mean risk-free. And that's because bonds typically have two types of risk. First is credit risk, or the chance that the issuer defaults on their debt, they're not able to repay those payments. Therefore, investors don't receive their full principal investment back. There's also duration risk, which measures the sensitivity to the price of a bond with respect to changing interest rates. And on the right-hand side of the page here, we have a Morningstar style box that plots out the different types of risk. Going horizontally, you have short, intermediate, and then long-term bonds. Typically, shorter-term bonds are viewed as less risky from a duration standpoint, because as that bond matures, if rates then head higher, investors can reinvest those proceeds at higher coupons as opposed to owning a lower yielding security for a longer period of time. Then vertically, we have the credit quality, not surprisingly, lower quality issuers, so folks that are deemed a higher risk to be able to make those repayments. Those are obviously considered a higher risk versus higher quality issues that have strong balance sheets, that have sustainable earnings, that have never defaulted on their debt. And so we'll talk about both of those in just a moment. With respect to credit, the U.S. government has never defaulted on their debt. They have, as a result, virtually no credit risk. And as you can see there, they've received some of the highest ratings from the top rating agencies around the world. However, the trade-off is considering they have virtually no credit risk, they are hypersensitive to changes in interest rates. And I want to share an example to potentially bring this to light. Let's say you went out, you spend $1,000 buying the state-of-the-art brand new TV with all the bells and the whistles. It's the top of the line, you're very excited about it, and then the very next day, the same company you bought it from came out with an even better TV listed for the same exact price. In theory, your TV is now worth less because no buyer is going to pay you $1,000 for your TV when they could spend the same amount and get an even fancier one that the company just released. The same concept works with a bond, where if you enter into a loan with the US government and then interest rates march higher, all of a sudden your bond is worth less because a new investor or a new lender could, in theory, go out and get more income based on the changing rate environment. That resulting change in price or sensitivity to changing interest rates is referred to as duration, which attempts to forecast what is the decline in price for every 1% move higher in interest rates. And to give some context, on the left-hand side here, we have the US Bloomberg Aggregate Bond Index. That is an index of all types of fixed income. You can see the duration there of 6.5 years. So again, estimating that a 1% move higher in interest rates the US Bloomberg aggregate would decline in price by 6.5%. The right-hand side of the page here, we have the Bloomberg long-term Treasury index, and that has a duration almost 3 times. So again, the point to emphasize here, long duration treasuries have significantly more duration or sensitivity to changes in interest rates. Now, historically, during periods of equity volatility or bear markets, that duration acts as your friends. Illustrated on the screen here, we have 2008 performance. We have the S&P, which, as most of you remember, during the global financial crisis, traded down 37%. And in response, the Federal Reserve came out, lowered interest rates as a way to help stimulate the economy. And that was a boost to US Treasury securities. We saw the long-term government bonds actually rally near double digits, helping to offset some of that equity volatility. However, not all bear markets are created equal. Although it's far less common, there have been a few scenarios, 2022 included, where higher interest rates, which in response to historic inflation, were actually the root cause of the equity bear market. So up here on the screen, we have the year-to-date performance, again, of the S&P 500, as well as the long-term Treasury index. And you can see for only the 3rd time in history, both of these have entered into a bear market, which is defined by a decline of 20% or greater. And again, this was a function of higher interest rates designed to help combat what has been historic inflation. So the question therefore becomes, is it time to buy? My response is not necessarily. I think the decision to own long-term Treasury bonds really comes down to your outlook for interest rates and specifically where they go for here. Keep in mind, if inflation remains elevated and the labor market continues to show its strength, that in all likelihood paves the way for the Federal Reserve to continue to march interest rates higher. Likely would expect additional hikes, which would put further downward pressure on longer duration assets. Granted, if inflation moderates or we have a significantly weakening labor market, that may prevent additional rate hikes. But where you really want to own fixed income is when interest rates are on the decline. And that would require dramatically lower inflation or a weak labor market where the Fed would actually then step in. And instead of having a restrictive economic policy, I would actually go to more of a accommodative one. At the end of the day, although we don't necessarily expect inflation to remain at historically high levels, it's very difficult to forecast exactly when the when the Federal Reserve would anticipate cutting interest rates, which is a scenario or the time where you would want to own government bonds. Now, the question that came in last week was, if I own these or hold these bonds to maturity, will I make up that negative 30% loss? The answer is yes. However, requires you to be very patient. If these bonds mature over a 30-year period, it would take some time, a la the 20 to 30 years, in order to recoup that. So the question from a timing standpoint is, do we want to own those longer duration assets? Certainly, they do kick off a more attractive income or yield today versus what they were January 1st of this year. But from a tactical allocation in a portfolio, unless you have a high conviction that inflation is meaningfully coming down, the Federal Reserve will ultimately come out and cut interest rates, don't necessarily know this is the time I want to own them based on that two-way risk of rates potentially moving higher. So that's all for now. As always, please encourage you to submit any questions, as well if like to ever discuss in more detail, always available. Have a great rest of the week. Take care.